Greetings to everyone. Raquel Media here, and today we're talking about realization of assets and liabilities, which is lesson 9 of the principles and practice of taxation. Right. So basically, the overview of this chapter, right, is to let you know that whenever you sell an asset and then you make profits, like let's say you bought it 50,000 and sell it for 60,000, the difference is is taxable, right? The same way when it comes to liability, if in case you are owing someone 50,000 and the person says that, oh, I'm dashing you 10,000 out of it, so just pay 40,000. That gain, that difference will be taxable. That's the overview of this lesson, right? So our lecture said that we will be examining up to some parts of this session, and the other ones are just adapts that you can learn them on your own. But I'm going to treat it, but in a very fast pace when I get it. All right, so this is it. Now, these are some of the reading lists you can look out for. All right, so in the introduction session, taxation of gains from the realization of asset, which is basically saying that from when you sell an asset or a liability is an important element of any income tax system. So even though capital gain does not actually contribute large amounts to the government revenue, right? They taxing it is a very good way so that whenever businesses make profit, they wouldn't just use it to go and just buy anything like that. You get it? Otherwise, people would have been doing that. So the absence of tax may provide avenue for taxpayers to convert otherwise taxable income into tax-free gains, right? So this situation may create unfairness and inequitable payment of taxes in the country. So this lesson is written with the sole purpose of guiding us, students, through the provision related to disposal of gains and losses under the Ghana Income Tax Act 2015, Act 896. So let's say currently I'm in 400, so by next year I'll be done. So if in case you are new to 400 and you are seeing this video, make sure you pay attention to this chapter because we had an in-class test on this chapter, right? So we had an in-class test on this chapter, and then it was only 7 minutes for 5 questions. You can just imagine the pressure. So kindly go through this chapter and also read the arts and any other reading material that you come across to so that it can enhance your understanding on this. All right. So this is the scope of taxing capital gains. So under Section 35 of the Ghana Income Tax Act 896, gain from the realization of an asset or liability is any amount by which the consideration received for the asset or liability exceed the cost of the asset or a liability at the time of disposal. So this is what I explained, that let's say you bought an asset for 50,000 and you are selling it for 60,000. The difference is the gain, and that's the taxable amount. And for in case of the liability too, you are owing someone 50,000, the person is saying that no, by I'm giving 40,000 out, so just pay. I'm giving 10,000 out, so just pay 40,000. The difference, which is the 10,000, becomes a gain to you, and it is supposed to be taxable. So a loss on reduction of an asset or a liability. So this is a loss is when, let's say, you buy an asset for 50,000 and then you're selling it for 40,000. You've made a loss on it. And let's say on a liability, for example, let's say you are owing someone 50,000, and because you were not able to pay early, right? It has now increased to, let's say, 60,000, right? That's you accumulated a cost on it. So is the amount by which the cost of an asset or a liability exceed the sum of the consideration received for the asset or liability at the time of disposal. All right, so let's move to the determination of cost of an asset. So the cost base of an asset comprise the expenditure incurred by the person in acquiring the asset. Remember, I 16, we did something like the cost of an asset is includes the purchase price and any cost that was incurred in bringing the item to use, right? So that's the same thing here. So expenditure incurred by the person in acquiring the asset, which include manufacturing or constructing the asset, and then any amount expended wholly and exclusively in altering, improving, and maintaining or repairing the asset. So if in case you bought an asset for 50,000 and you improved it to let's say 60,000, the 10,000 difference, you improved it by 10,000. That 10,000 becomes your what? The cost to the asset, right? In taxation, for example. So it also includes any incidental expenditure incurred in effecting the acquisition and realization of assets. Right? Example, fees or commission. Any fees or commission you paid in acquiring or in direct proportion to the assets acquisition is also included as the cost of the asset. So um, let's move on to the determination of consideration received. Right. So section 37 of the Act defines consideration received to mean, right, any amount derived by way of altering or decreasing the value of an asset, and an amount derived by way of covenant to repair that asset or otherwise. So the value of consideration received, however, does not include an exempt amount. So a fine or a final withholding payment very soon. Okay, I think. And then an amount directly included in calculating the income of a person under Division 2 of Part 2 of the Act, right? So let's move on to the realization of assets. So capital gains or losses arise for the purpose of taxes only when there is realization, which is only when you've sold the asset, right? So the most common form of realization occur when the asset is being sold. Okay. The concept of realization is, however, far broader than just sale, right? So aside selling the asset, we can say that realization has occurred when the asset is being sold here and exchanged, when it's being exchanged, when it is being transferred, when it is being distributed, when it's being cancelled, redeemed, destroyed, lost, expired, or surrendered, right? So an asset of a person who ceases to exist, including by reason of death. So when someone dies, we assume that what there has been a realization on his asset, right? So an asset other than trading stock or a depreciable asset, where the sum of consideration received from owing the asset exceed the cost of the asset. This is straightforward, right? An asset that is a debt claim owned by a person other than a financial institution. The person reasonably believes the debt claim will not be satisfied. The person has taken all reasonable steps in pursuing the debt by AMFA, and the person writes the debt off, right? Then we also have trading stock, a depreciable asset, a capital asset of a business or an investment asset immediately before the person begins to employ the asset in such a way that it ceases to be an asset of any of those types, right? So an asset that changes its form, right? That's what this is trying to say. So these are some of the meaning of assets. So under the Tax Act, Section 133, right? An asset includes any property of any kind, whether tangible or intangible. Currency, which includes the money, right? And then goodwill, customer reputation, good reputation, and those kind of stuffs. And then know-how, your expertise and stuffs are all assets. A right to income or future income. Let's say you have stocks in a firm where you will be receiving dividend, like a right to income. You have right that you receive some kind of money from somewhere. It is what an asset. Then a benefit that lasts longer than 12 months. Let's say leases, right? A lease that lasts longer than 12 months, for example. And then a part of or any right or interest into or over an asset. When you have rights over an asset or interest in an asset or over an asset, we can say that it is an asset to you, right? Then the act, however, excludes from the definition of chargeable assets, trading stocks, or depreciable assets of businesses. So we look into that. So these are the exemptions. The following gains from the realization of assets in Ghana are exempted from tax deposit. Remember, in taxation, most of in an IAs, they know that we know this. So what they are going to do in the IAs, they are going to twist this. So they can see that first point is that the realization of gains on securities traded on the Ghana Stock Exchange up to December, right, is exempted, right? But in IA or increases, they can say that the realization of gains, which of these are exempt from are exempted from tax, right? And then you can see, maybe you may see the realization of gains on stocks, right? When you see gains on stocks, it's not part because the stock has to be what? Be on the Ghana Stock Exchange up to 31st December 2021 before it will be exempted, right? And then the realization of the B is saying the realization of gains on bonds issued by the government of Ghana by a non-resident. So let's say in the possible answers, they can say the realization of gains on bonds issued by the government of Ghana by a resident person. Know that it is not exempted. If it is a resident person, it is not exempted. But if it's a non-resident person, then it is what? Exempted. Then we also have a company's capital gains resulting from a merger, amalgamation, or reorganization of the companies where there is continuity of the underlying ownership in the assets of at least 50%. So you can see all this and then they can say that the assets of at least 40% know that it is not part. This is what I've been seeing in our eyes. That's why I'm touching on it. Then when a person uses the gain realized to acquire a replacement asset within 6 months before the date of realization. So you made some gains on the assets, right? And then you use that asset to buy that like this same kind of asset within the 6 months or before 6 months of realization. It is exempted. Sometimes in IA they can say after the date of realization. No, and I know that that's not it. Then, when the amount received on the realization by a person is generally used within 1 year of realization to acquire a replacement of asset. So here, you see, it is what? Within 1 year, right? Within 1 year of realization. And here is before realization. Keep all of them in your mind. And then here, know that it is a replacement asset. So let's say you sold a house or you had a gain on a house. Know that the replacement here is buying a house and not a car. If you buy a car, it is not what? A replacement. So it should be the same house. Not the same house, but it's not the same type of house, but like a house. So here are the modes of taxation. And this was where our lecture said it's like at our level is important, like what we should know is up to this point, right? But we'll move on. So the methods of taxation, right? So we have two methods of taxation. It's either you include it in your chargeable income and then tax it as your normal tax rate, or you tax the gain differently at a rate of 15%. But note that businesses are automatically allowed or are enforced to add it to their um, net income for that particular year. And then they are going to apply their 25% corporate tax on it. All right. But as an individual, you have two options: either to charge it differently or include it and then tax it with a graduated tax rate. Keep this. As individual, dear, you have two options. Either to, so you see, where an individual chargeable income includes gain from realization of asset, the Act allows for the individual to opt for those gains less any losses for realization to be taxed at 15%. So you can either do this or add it to your income. So we are going to talk about this very soon. You will see an example very soon. So this is the format for it, where if you want to know your chargeable gains, it is the consideration received, the amount that you sold the asset for, less any cost. So we have the purchase for the cost where the cost you bought the asset, the incidental cost, which might be commissions and those kind of stuffs, any cost of improvement, right? And then cost incurred in realizing the asset, right? Then you subtract all of them from it, and then the difference becomes your what? Your chargeable gains. So we'll see an example very soon. So this is an example. S&M sold a building on 15 January 2018 for 32,820,000 Ghana cedi. The building was purchased on 24th January 2012 for 164,000 and was extended at a cost of 37,000. During 3rd March 2012, S&M incurred legal fees of 3,600 in connection with the purchase of the building. In connection with the purchase, okay? And legal fees of 5,800 in connection with the disposal. S&M operates a clothing line business in Ghana, in Accra. For the year ended 2018, she declared a net profit of 7,500 from the business. The business expenses as follows. This is the business expense. That's different from the building expense. All right. So now they say what will be the capital gain tax payable by S&M? And then S&M has two options, which is the gain on realization. She can add the gains to her business income and tax at graduated tax rate, or opt for the gains to be taxed at 15%. So now let's look for the gain. The gain is the amount. We have to bring up the amount she sold the asset for, with less the cost of acquisition, enhancement costs, and also the cost incurred in connection to the building. We have the incidental cost, this was the cost of disposal and the cost of the legal thing. So when we add all, this is what we are getting. And this is our total cost here. When we subtract the total cost from it, then this will be our chargeable gains, and we are now using the 15% rate, right? So at the 15%, it is the amount she pays for the tax on the gains, right? Then we adjust his business income to, this was his net profit, her net profit. We add back depreciation because it's not allowable. Cost of renovation is not allowable. Then we less our capital allowance. This is what we get, and this will be what? A chargeable business income. Now, we apply the tax and the graduated tax rate on it for the year 2018. And this is the tax liability we get on that. So when we add it to the capital tax gain, this is the total tax she's supposed to pay. This is when she opts in for the 15% and also for the graduated differently. Now let's look at something. If in case he decides to add all of them together. So the second option, we get the same chargeable income and then the same gain. So this will be a total chargeable income, right? Now we apply the graduated tax schedule on it because she is planning to what? Apply the graduated tax rate on all her gains. So this is what the total tax that she's supposed to pay when she applied the graduated tax rate. So the graduated tax rate first 3,132 is nil. 850 is what 5%. That's it here. Then the next 1,200 is 10%. That's it here. The next 33,720 is here. That's what we are. It's 17.5. That's what we are seeing here. And the next 83,328 is this 25%. That's what we are seeing. So this is the total tax. So you can see that another second one, the tax is higher than the first one. So many now go for the first one. All right, so now let's look at cost and consideration liability. We looked at assets, now we are coming to look at liability. And I said that liability, I've even explained this already, but let's go to what the act is saying. So section 39 of the act provides for the cost and consideration received for liability to be determined in a way consistent with the cost and consideration of an asset. The following are to be included in the cost and consideration of liability. So the cost, which is the expenditure incurred in realizing the liability, and the consideration received, the amounts derived in respect of incurring the liability. So this is an example here. So normally for this particular part of this cost, it normally deals with a situation where the firm deals in, like, let's say, foreign kind of transactions, right? So this is an example here where Patrice bought or purchased 150 bags of sugar from China on 4th April 2017 at a cost of $180 per bag. And he was given a 4 month credit facility, like he should use 4 months to pay. Please. So look at the exchange rate when he bought it, and then the exchange rate when he's about to pay it. You can see there's a difference, 4.54 and then 4.82. There has been an increase. So when you calculate the cost before and then the cost at 4.54 and the cost at 4.82, the difference becomes a what? A loss on realization of liability, right? So this is more or less like the foreign exchange one. And when it's home based too, that's when I said, let's say there has been a reduction in your in the loan that's in, let's say, in the liability that you are owing, right? So the loss now is what? The difference. Now you are what? Paying more than what you were supposed to pay, right? So there has been a loss on it, right? So this is the loss. In case of a gain, then let's twist it. Let's say you were buying it when it was 4.8, and then you are now coming to pay when it is 4.5. There has been a gain on it, right? And that gain will be taxed. Tax one don't pay himself above. So there is a reverse qualification and compensation of amounts in this section. So section 42. So where a person includes expenditure in the cost of an asset or liability and later recovers the expenditure, the person must include the amount recovered in the consideration received for the asset or liability as the case inquires. So this is just straightforward, right? And also, where a person includes an amount derived in the consideration received for an asset or a liability because of legal obligation to do so, and later receives a refund for the amount, the person may include the amount refunded in the cost of the asset. This is also straightforward. So C, subsection 4 applies where a person or an associate of a person derives a compensation amount which represents a recovery of actual or expected cost, or expected but not received consideration for an asset or liability, or a loss in value of an asset or increase in liability. So let's say you are compensated for something, right? But you've not really, you see, or expected cost, or but not yet received consideration for an asset or a liability or a loss in value of an asset. Then we can also see a reverse quantification and compensation, right? So another part here is the compensation amount subject to any other adjustment under the act is included in the consideration received for the asset or liability as the case may inquire, right? So now let's look at the case where assets are transferred to spouse or former spouse, right? So when an asset transfers, when an individual transfers an asset to a spouse or former spouse in the event of death or as part of a divorce settlement or bona fide agreement or separation agreement, the individual is treated as deriving an amount in respect of the realization equal to the net cost of the asset. So uh, let's say you bought an asset for 50,000, right? And then you incurred, let's say, a cost of 10,000. And now you are transferring the asset to someone. What we are trying to say, what the act is trying to say is that since you bought the asset 50,000 and you incurred a cost that was associated to it at 10,000, then now the total value of the cost is, of the asset is 60,000. Then what we are trying to say here is that 60,000 becomes the asset that you've transferred to the person. Even though, let's say, the current value of the asset might be 80,000, but still the net cost of the asset immediately before the realization, right, is what has been transferred. So the spouse or former spouse is treated as incurring expenditure of the amount referred to in acquiring the asset. So this is a situation here. So David transferred a building located at Kasua on 21st March 2018 to Linda, his former wife, as a settlement for their legal divorce. The building was purchased in 2003 for 40,000. Repairs and maintenance carried out on the building amounted to 5,600. David paid 1,200 to a lawyer to prepare the necessary documentation for the transfer. The market value of the building at the time of transfer was what? 67,000. Now let's look at it here. So you can see that the cumulative cost of the building is just the purchase cost, right? Which was what? 40,000 plus the repairs and maintenance plus the legal fees. So 46,800 becomes the cumulative cost. So the net cost of the building becomes the cumulative cost, right? Which is what? 46,800 here. So David is treated as deriving an amount of 46,800 in respect of the realization of the building. Linda is treated as incurring expenditure of 46,800 in acquiring the building. So replacement asset relief. So where a person realizes an asset in any of the manners as described in the act and uses the proceeds from the realization to acquire the replacement assets within 6 months. We've spoken about this already. Before or 1 year after the realization, the person is treated as deriving an amount in respect of realization equal to the net cost of the asset immediately before realization, like what we just did, and then the amount, if any, by which amount derived in respect of the realization exceed expenditure incurred in acquiring the replacement of the asset. So this is an example here. So Asante constructed a building at a cost of 300,000 on 1st May 2012 at La Paz, my home, my base. That's where I stay. In The year 2013, owing to flooding caused by rain water, he had to undertake repairs. He had to undertake repairs on the building, which cost 20,000. Asante had an insurance policy with Enterprise Insurance Company Limited to the tune of 10,000, covering the house, and all premium had been fully paid to that value. He decided to relocate from La Paz to East Legon and sold the house to Trust Construction Company Limited for 390,000 on 2nd August 2018 through Wise Agency, who were paid 1% of the sales price as commission. Our requirement is to calculate the capital gain tax payable by Asante if any, on the disposal of his building, and B, if Asante used 360,000 out of the proceeds received from the sale of his building to acquire a building at East Legon on 1st September 2018, what would be capital gains tax payable by him, right? So you look at it here, it's so easy and simple and straightforward. So the consideration received this year, you are looking at the first option. So the cost of construction was 300, cost of alteration is what? 20,000, insurance is 10,000, sales commission is 390, right? And it's ended up at getting this, right? So when we subtract, then on the normal note, this is what is going to be our chargeable gain. But let's look at the case where he used 360,000 out of this. So you can see that when he used 360,000 out of it, so this would be capital tax here. All right. So when he used 360,000 out of it, so after getting all this, we had what? 3,900, right? And that will be our accessible capital gain. But let's look at the replacement relief where he used 360 cedis to buy a similar house, or like buy a house which is in a form of replacement. Then when we subtract it from here, we are going to get this, and then we take it out of our accessible gain, and then we get our chargeable gain to be 30,000. So you can see that since there was something like a replacement, then the chargeable gains has reduced. Therefore, his capital tax gain has also what reduced, right? So let's look at cost and consideration received under partial disposal. So partial disposal, this is student surface, right? Where a person acquires one or more assets by way of transfer at the same time or as part of the same arrangement. The expenditure incurred in acquiring each asset is apportioned between the assets according to their market values at the time of acquisition. So where a person realizes one or more assets by way of transfer at the same time or as part of the same arrangement, the amount derived in realizing each asset are apportioned between the assets according to their market values at the time of realization. Where a person who owns an asset realizes part of it, the net cost of the asset immediately before the realization is apportioned between the part of the asset realized and the parts retained according to their market values immediately after the realization. Right. So this is an illustration of what I just read. Right. So Mr. Chumba acquires 10 plots of land at Medina for a total of 25,500 in 2010. He disposed 2 plots of land in 2019 for 12,000. Mr. Barr incurred incidental expense amounting to 7,000 at the time of realization. The 10 plots of land held at the time of realization had a market value of what 60,000, right? So what we just read was like we were apportioning it between the parts. So let's look at. So now this is what we received when we sold the two plots of land. Now we have to apportion the 12,000 what we received by the current value and then see the percentage. It is for 20% of it. So now we apply that 20% on the time that we acquire the land and we are getting this. So our incidental expense is this. Now our chargeable gain is what? This. We apply our 15% tax on it and we get this as our capital tax. So this is basically the summary of what we just did, which is trying to say that this lesson examines section 35 to 50 of the Income Tax Act 2015 at 896, which set out the provision relating to taxing of gains and losses in Ghana. For tax purpose, the gains and losses derived from the realization of an asset and liability is included in the business income of a person. The Act, however, allows individual the option of applying a tax rate of 15% to the gains from realization of the assets, which I have spoken about. Then where the gains of a person is used to acquire replacement assets within 6 months before and 1 year after the date of realization of the asset, the Act allows for a relief to be granted on the use for the replacement of the assets, right? So these are some questions you can look out because I think similar one came in the IE. You can also look at this. In the IE that we did was written, but needed critical thinking. You can look at this. Right, this is a replacement something. So C, constructed a building whatsoever. But assume he had used 27,000 out of the proceeds to acquire a motor vehicle. This is not acquiring a building, a motor vehicle, so it is not a work. The person will not get a replacement to leave, right? So another one is here. Another one is here. You can look at it and then solve them. In case you have further questions, you can drop it in the comment section. Don't forget to like this video and also subscribe to my channel. See you some other time. Bye.